Can you actually make a great trader, or are they just born that way? Well, that single question sparked one of the most famous and frankly wildest experiments in financial history. We're going to dive into the legendary story of the Turtle Traders, a group that completely changed how people thought about the markets.
And it all kicks off with this one simple but powerful idea from commodities legend Richard Dennis. Forget trying to predict the future. The real secret, as he said, is to minimize your losses and try to preserve capital for those very few instances where you can make a lot. And that idea, it's the key to this entire story.
So let's go back to the early 1980s. Richard Dennis makes a bet with his partner, William Eckhart. It was basically the ultimate nature versus nurture debate, but, with millions and millions of dollars on the line.
Eckhart was convinced that great traders were just born different, that they had some kind of natural talent, a gut feeling for the markets. But Dennis? He wasn't having any of it. He made this incredibly bold claim. He could take pretty much anyone off the street, teach them a complete, purely mechanical trading system, and turn them into a star.
And you know what? He put his money where his mouth was. He went out, recruited this diverse group of people, some with literally zero trading experience, and gave them his own money to trade. He called them his turtles, and the results were just insane. For a few years, they were reportedly pulling in an average of, wait for it, 80% a year. Compounded. It really seemed like Dennis had won the bet, hands down.
So, what was this magic system all about? Was it some secret formula for picking the exact top or bottom of a market? Not even close. The real secret wasn't about when to get into a trade, it was about something way more fundamental. See, the secret sauce, the absolute genius of the Turtle system, was this set of 5 incredibly disciplined rules. And they weren't about entries. They were all about how to manage your risk and size your bets after you were already in a trade.
Okay, first up, they completely threw out the idea of a fixed stop loss. Instead, their risk was dynamic. It changed based on how choppy the market was right then and there. They used a simple indicator called the average true range, or ATR. Basically, the more market was swinging around, the wider their stop loss became. This gave the trade room to breathe so it wouldn't get shaken out by random noise.
In this slide just illustrates the logic perfectly. Look on the left. In a quiet, calm market, a tight stop-loss makes total sense. But now look at the right. During a really volatile period, that same tight stop would get you knocked out of a potentially huge winner almost instantly. Their system adapted by using a wider stop to survive all that noise. It's brilliant.
Now, here's the really crucial part. They always risk the exact same percentage of their account, let's say 2%, on every single trade. But since their stop-loss distance was always changing with volatility, their position size had to change too, right? So as you can see here, in a quiet market, they might trade 500 contracts. But in a super volatile market, to keep that risk at a constant $2,000, they can only trade 200. Less volatility meant bigger positions, more volatility meant smaller ones.
Okay, secret number 3 was managing risk across their entire portfolio by understanding how different markets move together, or what we call correlations. Some markets, as you see on the left, tend to move in lockstep. Others, on the right, do the exact opposite, and knowing the difference is absolutely critical.
And this is why it matters so much. If you buy 2 markets that are highly correlated, you think you're diversifying, but you're not. You've basically just made the same bet twice, and you've doubled your risk without even realizing it. The turtles were explicitly taught to avoid this kind of hidden risk trap.
The last 2 secrets were just pure hardcore discipline. First, they would add to their winning trades, pyramiding into a position as it became more profitable to really maximize their gains. And on the flip side, if they hit a losing streak, they would aggressively slash their trading size, forcing them to preserve capital when their system was out of sync with the market.
So there you have it, a system built on volatility, correlations, and ironclad discipline that just absolutely crushed the markets in the 1980s. Sounds pretty foolproof, right? But that was then. How does this legendary strategy hold up now in our modern world? I mean, think about it. Today's markets are a completely different beast than the trading pits of the 80s. We've got high-frequency trading, instant information, algorithms everywhere. So, the billion-dollar question is, do the original turtle rules still actually work?
Well, researchers at Sweden's KTH Royal Institute of Technology decided to find out. They ran a super rigorous academic study. They took the core turtle trading rules and backtested them over 20 years of recent data on major global stock market indexes.
The conclusion was, well, it was brutal, and frankly, a little shocking. After putting the rules through the ringer on modern markets, the researchers stated that the strategy, as it was originally designed, is just
not viable today.
So just how bad was it? The average annual return over a 20-year period was a measly 1.4%. And get this, that's before you even factor in trading costs, which would almost certainly push the final return into the red.
So what went wrong? Well, the study found the simple entry rules were constantly getting faked out by all the random noise in modern markets, triggering one false signal after another. But the bigger problem? The exits. The rules were just terrible at actually locking in profits, often giving back huge chunks of a winning trade before the signal to get out finally came.
So is that it? Is the legend dead? Does this whole 40-year-old experiment have nothing left to teach us? No, absolutely not. That's completely the wrong takeaway.
The key here is to separate the rules from the principles. On the left, yeah, you have the specific outdated rules, like buying a 55-day breakout. That might not work anymore. But on the right, you have the timeless principles. Sizing your position based on volatility, that is as important today as it ever was. Understanding correlations, crucial. Preserving capital during a drawdown, that's the bedrock of survival in any market, period.
And that brings us right back to where we started, with Richard Dennis's core idea. The specific tactics the turtles used might be obsolete, sure, but his relentless focus on risk management, on minimizing losses, on preserving capital, that philosophy is eternal. So the real takeaway is this. Markets are always going to change, and specific rules will always have a shelf life. But those principles of disciplined risk management, those are what separate a lucky streak from long-term survival and success. And that is the true, enduring legacy of the turtle traders.